The conference board yesterday said its leading U.S. economic index dropped 0.7%, that was March, after decreasing 0.2% in February. This was lower than a slide by 0.5% that was forecasted. The index had dropped 1.2% in the 6-month period ending in March after contracting 2.3% in the prior 6 months. Still, Justina Jabinska-Lamonica, analyst at the conference board, said the data, which is a gauge of future U.S. economic activity and though potentially flagging tepid growth, does not suggest that a recession has begun or is about to start. Hello and welcome to Global Business Insights, where we look closer at some of the headlines moving markets and provide analysis and perspectives. Looking at Wall Street and global markets, there are three main dimensions impacting sentiment. First is the Trump 2.0 tariff trade, and we will present a view by Accenture in a recent publication on the scenarios and potential responses. Trump comments urging the Fed to cut rates has also got markets worried about Federal Reserve independence and what that could mean going forward. Trump also met with representatives from major retailers, this including Walmart, Home Depot, Lowe's and Target. That was yesterday afternoon, to discuss the effects of broad-based tariffs on their businesses. The second dimension is the narrative on the macroeconomic data, which according to International Monetary Fund Managing Director Kristalina at the flagging of the spring meetings, she said there is no expectation of a recession, even though the IMF is expecting a markdown. Recent retail sales and global trade data suggest a ramp up of activity as traders stock ahead of impending tariffs. The next spate of data we're going to see in Q2 is expecting a slowdown as probability of recession spikes up amid all the tariff negotiations that are going on in the quarter. The third dimension are the corporate Q1 releases and the expected pullback in guidance to reflect present realities. Markets have priced in bad news on corporate guidance, and any upside surprise will help sentiment. Yesterday, gold rallied to new all-time high at $3,400 per ounce as we saw all three major indexes down more than 2%, with steep losses in the Magnificent Seven group of mega-cap growth stocks weighing heaviest on the tech-heavy Nasdaq. A concurrent slump in stocks, the US dollar and treasuries suggest tariff initiatives may have set in motion an exodus from American financial assets that even negotiations breakthroughs may find hard to reverse. Tesla shares slumped on news of delays of a stripped-down version of Tesla's Model Y crossover vehicle, a much-expected lower-priced model. Tesla is scheduled to report Q1 earnings after the closing bell today amid already signaled falling sales at the electric vehicle maker. Alphabet will also post results on Thursday after the bell, after tech stocks led the market lower last week. Other reports to watch this week include tomorrow Boeing, and then we get IBM. Also on Thursday, Merck, PepsiCo, Southwest Airlines, Procter & Gamble and Compass, as well as Intel will report earnings. It could be that earnings season is likely to be just a footnote when you compare to the trade war wranglings and the impact of any rhetoric targeting the US Fed. We have to watch and wait and see how all this develops. Saudi oil giant Aramco yesterday signed a joint development agreement with Chinese electric vehicle manufacturer BYD to explore collaboration in the development of new energy vehicle technologies. The agreement, signed by Aramco unit Saudi Aramco Technologies Company SATC, aims to enhance vehicle efficiency and environmental performance as the kingdom steps up efforts to transition toward cleaner mobility. The deal was after US EV maker Tesla also launched its presence in Saudi Arabia with an event in Riyadh that was on April the 10th. China has warned retaliation against countries that cooperate with the US to compromise Beijing's interests as the US administration exploits tariff negotiations to pressure its partners to limit dealings with China. And still in China, CATL, a Chinese company, has unveiled a battery that it said could provide a car with 520 kilometers of range after 5 minutes of charging. The technology would improve upon batteries developed by BYD, which last month released one that offered 470 kilometers of range with the same charging time. Both companies are ahead of Western car makers in battery technology. In South Africa, Finance Minister Enoch Godongwana says the government will either have to increase its debt or implement spending cuts to plug a 13.5 billion rand shortfall in revenue should a proposed 0.5% point VAT hike, which comes into effect on May 1, is suspended. This, he said, in response to applications by other parties to halt the VAT hike, also as the minister defended the constitutionality and lawfulness of the VAT rate announcement. And in Nigeria, according to the latest money and credit statistics released by the Central Bank of Nigeria, CBN, the total value of currency outside the banking system rose to 4.6 trillion naira in March 2025, accounting for 91.9% of the 5 trillion in total currency in circulation during the period. This showed continued dependence on physical cash despite the government's cashless policy push and marks a significant increase compared to the same period in 2024 when 3.63 trillion naira was held outside banks out of 3.87 trillion naira in circulation. The new figures represent a 26.7% year-on-year increase in currency held outside banks and a 29.3% rise in total currency in circulation. Capital inflow for Nigeria January 2025 rose to a two-year high at $2.06 billion from $1.57 billion in December 2024. Portfolio investment inflow increased to US $1.85 billion from $1.23 billion, but foreign direct investment, which is more closely related to stability and competitiveness, declined to $0.07 billion from $0.12 billion in December 2024. Accenture recently published its view on how companies should respond to trade tariffs, which has seen average trade-weighted or effective tariff rate on goods imports into the US rising to about 29%. This is the highest level since the early 1900s and up from only 2.5% at the end of 2024. As the new tariff regime reshapes the global business landscape, it argues that resilience should be at the top of every executive's agenda to be able to navigate this historically volatile environment. Strengthening enterprise resilience means, first, a rigorous insight into the immediate and long-term spectrum of risks facing the company. Indeed, only Canada and China have implemented retaliatory tariffs against the US, as the EU and some others signaled to retaliate, but then they put their retaliation on hold in response to a 90-day pause. According to Accenture, given the high level of uncertainty at play and the frequent shifts in US trade policies in recent weeks, there are three broad future tariff scenarios. The first scenario of pragmatic de-escalation would imply reciprocal tariff reductions are negotiated for most countries, as well as possible exemption from some of the product-specific tariffs. In this scenario, the administration maintains the minimum 10% universal tariff to preserve support for the administration's reindustrialization and fiscal revenue objectives and limit the scope for tariff evasion via transshipment and other methods. This brings the U.S. effective tariff rate back down to a range of 15 to 17%, lower than the estimated 29% at present. That's the first scenario. The second scenario, after a hardline negotiating approach by the U.S. and a high bar for granting tariff relief, is called holding the line. This is where some allies secure tariff reductions from the U.S. after offering particularly large concessions, while for most others, the threatened higher reciprocal tariffs are ultimately reinstated. Under this scenario, additional product-level tariffs currently under consideration, such as for semiconductors and pharmaceuticals, would also be implemented in support of reindustrialization and national security considerations. This, according to Accenture, would keep the U.S. effective tariff in the vicinity of 30%. That is for scenario 2. In scenario 3, which is one of disorderly escalation involving failed negotiations plus significant retaliation, causing tariff rates to spiral higher and broadening of trade tensions, including restrictions on cross-border services, technology, and investment. This could push the U.S. effective tariff rate to over 40% and also increases in the tariff rates that other countries charge on the U.S. So how should companies respond? Accenture says companies should rethink how they manage their cost structure, network and logistics, as well as supplier relationships and sourcing strategies and capital prioritization to achieve improved profitability, cash flow, and return on invested capital. They must pursue operational resilience, which is about agility and the determined pursuit of productivity gains. Companies must also build commercial resilience, not just to protect margins, but to grow intelligently, even in down cycles. They must ensure that their innovation and marketing investments are aligned with emerging areas of opportunity. Companies also need to plan for the workforce impact of reindustrialization, reshoring, and restructuring, and support employees through that process. The use of digital information technology and artificial intelligence should play a central role, not just through automation, but through the focused deployment of technology and talent against the most critical opportunities and risks that a company faces. In short, the winning companies will be reviewing the context and responding to the challenges they face with a resilience that results in a competitive advantage. Asia-Pacific markets were mostly mixed, looking for direction as markets seemed to be awaiting clues on how trade negotiations would progress. And on negotiations, South Korea's acting President Han Duck-soo said today that he expects trade talks this week with the United States to pave way toward a mutually beneficial solution. Still in Asia, the US is compelling India to give online retailers such as Amazon and Walmart full access to its $125 billion e-commerce market as part of a trade deal being negotiated under the threat of increased tariffs. US stock futures edged slightly up following a tough day on Wall Street. European markets opened on a negative note amid lingering jitters around global trade. Traders are also keeping an eye on news and comments out of the ongoing IMF World Bank spring meetings in Washington this week. Well, that's all on this special holiday edition of Global Business Insights. This is Bode Oshosami. Thanks for watching. Bye-bye.